Hello and welcome. Today, we're diving into the world of digital money, but not the kind you might first think of, like Bitcoin. We're talking about central bank digital currencies, or CBDCs. What exactly are they? Imagine the cash in your wallet, but in a digital form, issued and backed directly by a country's central bank. Unlike cryptocurrencies, which are usually decentralized, CBDCs are centralized and carry the full backing of the government's monetary authority. Why are we hearing so much about CBDCs now? Well, the interest globally has skyrocketed. As of early 2025, over 130 countries, representing nearly all of the world's economy, are looking into them, exploring, developing, or even launching pilot programs. This surge is driven by a few key factors. Our payments are increasingly digital anyway, and central banks want to keep up. They also want to maintain control over their national currency in a digital age and offer a safe, reliable public option for digital payments. Now, designing a CBDC isn't simple. Central banks face big choices about technology. First, the basic infrastructure. Should it run on a traditional, centralized database, which might be faster and simpler, or use something like distributed ledger technology or DLT, often associated with blockchain? DLT offers potential resilience and programmability, but scalability can be a challenge. Many experiments use DLT but keep it under central control. Then there's the distribution model. Who handles your CBDC account? In a direct model, the central bank does everything: account opening, transactions, the lot. That's a huge job. More common is the indirect model, similar to today's banking. The central bank issues the CBDC to commercial banks or payment providers, and they manage the customer-facing services. There's also a hybrid model trying to balance central bank liability with private sector involvement. Finally, how do you access it? Will it be account-based, tied to your identity like a bank account? Or token-based, where the value is in a digital token, more like digital cash, potentially offering more privacy but making lost funds harder to recover? Each approach has trade-offs between privacy, security, and ease of use. So, what are the potential upsides? First, enhanced payment efficiency. CBDCs could mean faster, cheaper payments, both within a country and across borders. Think 24/7 real-time settlements, maybe reducing those pesky remittance fees. Second, financial inclusion. They could provide easier digital payment access for people without bank accounts, maybe even working offline. Third, innovation. A CBDC could be a platform for private companies to build new financial services, boosting competition. Fourth, some think it could help central banks implement monetary policy more effectively. And critically, it helps maintain monetary sovereignty, ensuring the central bank's money remains the anchor in an age of private digital currencies. It also offers a resilient alternative if private payment systems go down and might help combat illicit finance, though this raises privacy flags. But it's not all smooth sailing. There are significant risks. A major worry is bank disintermediation. If everyone rushes to hold super-safe CBDCs, especially in a crisis, they might pull large sums out of commercial bank deposits. This could squeeze banks' ability to lend money, potentially destabilizing the financial system. How a CBDC is designed, especially if it pays interest, is critical here. Privacy is another massive concern. How do you balance the need to track transactions to prevent crime with users' right to privacy? Then there's cybersecurity. CBDC systems would be huge targets for hackers, demanding top-tier security. Plus, developing and running a CBDC is complex and expensive for central banks. Getting the public to actually trust and use it is another hurdle. And finally, new laws and regulations are needed to govern everything from consumer protection to data privacy. In conclusion, CBDCs are a potential next step in the evolution of money, pushed forward by technology and changing habits. They offer exciting possibilities for better payments, greater inclusion, and financial innovation. However, they also carry serious risks for financial stability and raise difficult questions about privacy and the role of banks. That's why central banks across the globe are moving carefully, weighing the pros and cons, knowing that the specific design choices will ultimately determine if a CBDC is a net positive. It's a space we'll definitely be watching closely. Thanks for tuning in.